asset quality. It's more of a critique of the existing literature, first and foremost. Critiquing what has been done extensively in so many research papers, and most of the research actually is done by universities and even other institutions. We could start with this graph. I think it was mentioned, I think, several times that asset quality has become a major issue right now in Kenya. I did a moving average for the GDP growth for the last, 3-year moving average, and you can see the GDP growth is trending downwards, and it seems to have like a very disproportionately high impact on the trend, the asset quality trend. I think it's not uncommon to see investor briefings in major institutions in the published results talking about the impact of slow judicial processes, how they impact the asset quality. I think it's a common thing. I think it's actually obvious that how long it takes to recover debt has a major and a significant impact on the non-performing loans. And currently with the introduction of the IFRS 9 impairment model, banks can no longer ignore some of these nuances of the entire management of non-performing assets, because there's a particular assumption in terms of how long it takes to recover your debts, and you have to discount your cash flows based on that. Just looking at this slide, just go back. There's a judicial process. Go back. Okay. I'm the one running it? I don't know why it's not reflecting. Yeah, that. So this is a slide from the judiciary. There's a paper that was done by judiciary. I think it's actually a research paper, and it shows how long it takes to resolve different types of cases. It is very common to find that when a bank has an underperforming loan, typically if there's a collateral to be sold, there's always a case, a litigation. And looking at how long it takes in terms of days, you can see civil cases take an average of 979 days. The mean is about 624. That has a huge drag on how, in terms of releasing the cash flows back to the bank upon the realization of the collateral. And if you look at the second bullet there, it takes, a civil case actually takes between, this is just the range, between 1 day to 2,000 days before the first hearing. That's really bad. You can imagine tying cash flows for that long. And there's one particular case that took actually 8,300 days to be resolved, about 22 years. That is not a good thing. And I think, of course, you've seen currently, there are so many auctions happening, and literally almost all of them tend to involve, almost half of them tend to involve a court case. You know, having an injunction by a borrower is always a good way to buy time and figure out whether you can stop the bank and perhaps even negotiate. And here there's some anecdote I wanted to give about how long it took to resolve Chase Bank and compared to Silicon Valley Bank. I don't know whether you're aware how long it took to resolve Silicon Valley Bank. Silicon Valley Bank, it's a bank in America that used to finance startups. They had invested heavily in government bonds, American government bonds. But due to the rise in interest rates, the mark-to-market actually led to a situation where they had less, basically in terms of their liabilities and assets, they kind of actually tipped and they became insolvent. How long did it take to resolve Silicon Valley Bank? Who has an idea? It actually took less than a week, about a week, maximum 2 weeks. And depositors had access to their money. In Kenya, Chase Bank, how long did it take? Extremely long. I think almost 3 years for some depositors, and especially the high value depositors. So that actually tends to show us how it is. Of course, this is just anecdotes, it's not the averages, but typically Kenyans are very litigious, and that's a known fact. And that judiciary report shows that. So the whole idea then here, the motivation for this study is first to look at the impact of the long judicial processes, and then also, of course, it has a compounding effect. The longer you hold these assets, especially during the period of low growth, suppressed growth, high interest rates, then PLs will just keep growing with a hidden momentum. And then there's another point I wanted to mention. I think I started with it. Basically, a major critique on the studies where most researchers tend to talk about the bank performance ratios like cost to income ratio, deposit ratio, cash to assets ratio, loan to deposit ratio, and talking about those ones as if they affect non-performing ratio. So then you're saying, is that the actual direction? Or it's probably just a spurious relationship? Perhaps maybe the relationship is the reverse. Of course, talking about the literature, there's a lot of literature in this subject, and it's common sense. Higher defaults, of course, have a profound impact on the financial stability, and Basel addressed these challenges through stringent regulatory requirements. I think banks, we all know banks are very, very unstable, and I'll explain why shortly, but I think all of us, you're bankers, we know. And I suspect most of us also have an idea about economics. I'll explain that later. Obviously, defaults necessitate high impairment costs for bad debts, and they reduce income. Of course, banks under the Basel III are required to hold higher capital buffers, and which can also strain on profitability. Of course, these buffers are designed to absorb losses during financial stress, but they can also limit banks' ability to generate returns on equity. So studies have shown that poor asset quality is a recurring factor in financial crisis. The financial crisis of 2008 is a major point. And I think it also happened, that was 2008 global financial crisis. I think there's another paper there by Kant and in 1998, and they confirmed that poor asset quality is a determinant of banking crisis in both, not just developing countries, but also developed countries. So there's a long story there. I want to take the least time. So I'll talk a bit about the modern commercial banking. It's a fact that I think most of us who are economists are aware of, but those who are not economists may not be aware that banks lend money that doesn't exist. Did you know that? Banks create money out of thin air. This is the history of the modern banking, modern commercial banking. I think the first central bank that actually is on record as having developed the groundwork for the modern banking is the Swedish bank. Initially, it was actually just it was not a fractional reserve banking, but it actually laid the groundwork. And later on, the bank that followed, the Stockholm Banco, founded in 1656 in Sweden, issued banknotes and eventually started issuing banknotes that are not backed by any reserves, especially gold. Because the typical banking, the way it came up was you have to back up your notes with gold. There's something else I think I didn't put here. About 12th to 14th century, merchants used to hold valuables like gold and stuff. So if you have very valuable stuff, you would give them and then they give you a receipt. And that's how money, the modern money started. But the merchants also realized you can actually print new notes to do whatever you want to expand your commercial interest by just printing money that doesn't exist. And that is how the modern economies realize you can actually create much more money to allow the business, to allow the economy to have enough currency to support any activities that you want. So still the story of the stock of bank. So they issued the first banknotes in Europe, which were initially backed by reserves. However, they started issuing more notes than they had. And obviously this leads to very to high level of instability. That's the story, I think, a bit later. Of course, the goldsmiths as early bankers, all that stuff. I think I've gone through all that. Then you have, I think I've talked about that. Yes, so the goldsmiths and as early bankers, of course, they realized that they could print more receipts than, more notes than they actually had. This, of course, increases money supply, and it allows the economy to actually grow, because the more money you have, the more you're able to actually finance traders who want to do business. Without fractional reserve banking, as it is called, the economic growth and development will be really constrained. You can't actually do much if the banks are only allowed to lend the cash that you receive. I think I've talked about that. So obviously, so many studies about this area, why it's important to focus on, why basically the GDP growth is important. So basically it talks about some bit of literature in terms of why the impact of the GDP on non-performing assets. I think that's a common issue. It's a common and obviously intuitive explanation of why quality of assets will deteriorate when the GDP growth stagnates. And that is even compounded further because when the interest rates are high, the NPL, the quality of assets would actually deteriorate. It's not moving. Yeah, so this one is on just a comment on the bank-specific factors. Of course, poor credit risk management, inefficiency, low profitability. Of course, they're important, but quite a number of these are actually specific to banks. In the long run, what actually matters is mostly how the economy is moving. I alluded to the issue of the cost of income, for example, the issues to do with the liquidity. I mentioned something to do with operational cost and all that stuff. So this slide shows the Kenyan statistics for banks. I clustered tier 1 against everybody else. And one thing you note there is that tier 1 banks tend to have a very weird trend. They tend to have lower cash to deposit ratio than the smaller banks. They have cost income ratio is also much lower. Loan provisions to operating income is much higher than smaller banks. Then you have the other bit, which is government securities to total assets. You can see it's much lower, about almost half of the rest of the banks. Then you have, yeah, those are the ratios that you're talking about. So then the question is, why is it that larger banks have worse ratios than the smaller banks? Fractional reserve banking actually explains that. So then we have to state the research questions that we pose. Of course, we are asking, do these bank performance ratios actually determine asset quality, or is it the other way around? And then the impact of judicial processes, what is it? Then we think about how we can model the impact of the judicial processes, especially at a time like this. And then, of course, we'll have a footnote on exchange rate, which we'll discuss later. So this is a trend. Let me just use a table first. This graph shows what happens when the intermediation rate actually happens, when the multiplier effect goes up. So this is a simulation of a bank that starts with, let's say, about 1,000, let's say, 1,000,000 shillings. And as you continue doing the intermediation, all the ratios just collapse. The liquidity collapses from 50%, 57% to almost 22. Capital adequacy also drops. And here I've held the NPL ratio constant. Then loan to deposit, of course, it also collapses. And then assuming cost to income ratio of about 50%. This simple demonstration shows that the intermediation, the fact that the bank has to do intermediation, it leads to low ratios across the board. And there is nothing a bank that is willing to grow can do. Because if your intention is to increase the return on assets, I think as I demonstrated somewhere in another section for Kenya, yes, all the ratios have to collapse. And it is, I think, obviously intuitive that any bank, any small bank would like to become large. So the fact that you are aiming to actually grow your business, grow your assets, it means there is no way then you can, it's like a contradicting objective to improve the ratios and to grow the book. So that is where I was, that's the same slide. I think I just needed to put it back here so that we see. The very interesting ratio is, I think for me, is the cash, the average cash to deposits. For the larger banks, the cash to deposits is about 0.54. The banks have less cash than deposits, and these are the larger banks. And that is the whole idea behind the instability of the financial system. And that is why banks, I think, have been the most heavily regulated of institutions in history. So then the question then we have to go next now. We look at most of the variables that are usually surveyed. Obviously, I will exclude most of the variables that are usually the ones that I've just discussed, the bank performance ratios. There's no point to look at them. And secondly, it's more of a short-term analysis. So we are focusing on a period with extremely high with extremely low growth, like right now, and high interest rates. And we ran the model, first of all, on all these variables. Because of the high correlations and multicollinearity, we had to drop the majority of the variables, and we were left with only these two. And the model is quite simple. It's an OLS model. And so we regressed, and then the final results were simple. I know you were told not to put formulas, but it's simple. It's significant. R squared was about 0.36. Only two variables actually predictive. Okay, yeah. And then they are both significant. One is significant at 5%. And then we have negative relationship between asset quality and GDP growth. That's what we expect. High inflation, of course, means high NPL, and that is supported by theory. Then, of course, we decided to modify it and then look at the short-term behavior of the evolution of the NPL using a decay model. Basically, we are saying the fact that you are not able to dispose your assets quickly, the fact that the interest rates are very high, the fact that, of course, it takes longer to recover, then we can actually then just create this model to establish how the quality of assets will evolve in the short run, especially with those two conditions. Then we have to estimate the decay rate. Of course, the non-performing rates will decay. The non-performing loans will decay over time. Then we estimate the decay rate. Yeah. So that's the formula. Basically, it's an exponential formula to establish the decay rate. Then after, so this is how we estimated the decay rate. It's a simple derivation. The number here, 3 to 4 years, is an expert judgment number, which is backed by data. Most banks tend to you actually require to have this assumption of how long it takes to recover debts. So most banks usually state 3 to 4 years. Um, I think it's an average. It could be much higher for some portfolios. Some portfolios can actually even take up to 5 years even or more. Yeah, and that is when things are actually perhaps normal. So using that assumption, we arrived at a decay rate of about 0.69. So we then plugged in into this formula, and we also still retain the earlier formula, the earlier regression into the model as exogenous component. And then we then plotted the graph, how it would look like. So this is how it actually looks like. The red graph is the prediction, the actual is the blue. The R squared, the predictive power actually improved a bit. The mean squared error is also a bit lower. So suggesting that the formula, this decay model is much more predictive. Yes, so then as a conclusion, we can see that this model is actually much better. But again, I have to keep stating, it is for the short run when those conditions are satisfied. So basically, if the economy is slowing down, high interest rates, this is the best model for it. Those are the components I'm talking about. Of course, it captures the compounding effect of the judicial processes. Yeah. So there's a footnote I put there, though I did not put that information into this paper. The last bullet there, that during the periods of high growth, nothing else matters. If the economy is growing pretty fast, the interest rates are very low, the loan book is growing pretty fast, and obviously the non-performing ratio will just collapse on its own without even much work to be done. You don't even have to worry about it. So that is the end of that section. I'll talk a bit about something else that was of very huge interest as late as last year, and I think early this year. Quite a number of banks in their annual reports and investor briefings also talked about the effect of exchange rates. But eventually this year, actually the problem reversed. So as that last year, the end of last year, quite a number of banks had significant hit on the non-performing loans and of course even impairment because of the depreciating shilling. And the default was actually to convert quite a number of them to Kenya shilling. So the motivation for this bit was just to say what really happened and what can policymakers do to at least help the customers to manage their risk, and even banks in times of high volatility. This graph shows what happens when the exchange rate is, when the Kenya shilling is depreciating. Depreciating is when the graph is actually peaking. Appreciation is when the graph is falling. Something very peculiar you will note is that the volatility is very low when the shilling is losing value, but it's extremely high. If you just look at the spikes, the peaks and the troughs, towards the left, it's very low. You can see that. But towards the right, the volatility is extremely high. And basically this year, from January, the volatility was so high when the shilling was gaining against the dollar. So basically, we just wanted to explain this one, and this one was actually informed by some primary surveys on a few bureaus. Just a bit of the literature. There's a very critical paper here done by Professor Ndungu, the former CS for Treasury, and he actually observed that there can be deviations leading to misalignments in the currency value, influencing trade balances and overall economic stability. And that's why sometimes it's good to, that's actually why it's important to look at exactly what is the cause and what could be done about it. These are the findings from primary data and interviews. The forex bureaus, during that period, they were experiencing shortage of dollars. And this is an artificial shortage. And it was caused by the fact that they were unwilling to stock dollars during that time. Because when you stock dollars at a particular rate and then the rate falls significantly, they will not be able to sell them. So, and they actually preferred to buy dollars just from the retail market and not from banks or anywhere else, because then they could actually offer wider margins. And that's another finding we found, that the bid-ask spread, this difference between buying and selling of dollars, it was very, very high during this period. Most of the data, actually, we got it from data scraping from Twitter. There's a number of bureaus that post their daily rates, and the bid-ask spreads were very, very high during the high volatility period. It's basically to protect themselves against any losses. So to check whether this hypothesis of volatility, the risk aversion, is true, we use the ARCH model, a very simple model, and we found that it was significant with robust standard errors, suggesting that past volatility in the currency influences current volatility. And this could be an indication of risk aversion behavior. So basically now this is a bit of just a conclusion overall for the entire paper. That it's good for policymakers, at least for the NPL issue. I think the most important actually finding from this paper is that what matters the most right now is how can we stabilize the economy? Can we have the interest rate go back to normal? Which of course means, and it actually carries from the paper done yesterday, presented yesterday, that fiscal balance is very, very critical for banks. And that is the only way to stabilize everything. And at least once the economy picks up again, then the quality of assets would improve. And of course, even the judicial process is very important to improve that and see how delays in terms of how long it takes to unwind distressed assets and release the cash flows back to the economy can help. Because the non-performing assets are, I would call them dead assets, in the words of one, I think it's Hernando de Soto. Yeah, so it's very important to unwind them, and then so that the economy doesn't get that lag in terms of the drag, in terms of the performance. Of course, exchange rate, I think it could help to manage the friction by allowing these market players to either buy or sell directly and manage their risk. So that's the conclusion. This is just a footnote to the earlier part, just to show what happened when the situation was the opposite of what we have right now. From 2000 to 2007, when the growth was very high, the NPL ratios just dropped from 38% to 1%, just because of economic growth. And there's very little else could actually explain the improvement in the asset quality during that period. It was just the growth. Because when the economy is growing, the interest rates are low. There was a time I think even the treasury bill rate dropped to almost 1%, I think 2%. Yeah, so that is very, very critical to just show the important role of the policymakers. I think that is it for me. This is just a graph that I was explaining the fractional reserve banking, showing the, thank you.
Thank you, and thank you, Andrew, for that presentation and for the informative session and for the insights that you've shared on banking asset quality drivers in Kenya. So, as the discussant, what I'll do is I'll give an overview of what I understood from reading the paper from Andrew. So, from the objectives of this research, what Andrew wanted to find out by undertaking this research, at least from how I understood it, and I believe from what he's shared this morning, is that research shows that bank performance ratios, so maybe the ROA or the cost to income ratio, capital adequacy ratios, all these ratios, they play a significant role in determining NPLs. However, he's trying to see, is it really these ratios that determine the asset quality, perhaps measured as NPLs, or is it the NPLs that drive these ratios, these bank performance ratios? And also, there's been a mention about the judicial process, being a factor in the rising NPLs. And so again, another objective of this paper was to find out what's the impact of this slow judicial process on the non-performing loans in Kenya. And then also still on the NPLs to see, is there a model that can be used to predict the movement of this asset quality? And then he proposed using this exponential decay model. And then finally, there was the discussion on the exchange rates, how maybe there were some commercial banks that converted to US dollar denominated assets or facilities, and later perhaps took a hit given the appreciation of the shilling earlier this year. And given that, then he sought to explain what's perhaps to explain the volatility observed in the first half of this year and offer recommendations on the way forward. So so that's I would say an overall aim of the paper from what Andrew has shared. And so from reading the paper and from listening to the presentation as well this morning, so I found it's interesting and relevant information on the NPLs. I think in the paper that Andrew had, he shared good insights even on which are some of the sectors facing the highest NPLs, I think like trade and manufacturing, highlighting the importance of asset quality, why it's important, given that, if we have poor asset quality, then we can have financial instability, and that can hinder investments. And also, I found it very interesting, this discussion of the judicial process. And, as he mentioned, the average time for a civil case can take up to 979 days. That's like almost 2.5 years. So as the discussant, I'll kindly give my comments perhaps of what could be done to improve the paper. Given the time that Andrew has taken to work on it, it would be wonderful to improve on it and to see what, and I'm sure many people would be interested in it. So I would say probably simple things like citations would be needed, where to back up some statements that are made. If there are figures, which I think your work lends a lot, or this paper lends a lot to figures, if they're there, then they should be discussed in the literature, and kindly just to distinguish between exchange rate volatility versus exchange rate movement, because those are two different things. And also, I believe a good thing for the paper, given that there could be people from even the non-banking industry, or people not very conversant, to know what do we mean by asset quality, how is it measured. And I found this aspect of the link between the judicial process and NPLs very interesting. I thought, that's an interesting angle. I don't know if much research has been done on that. And even like, work, for example, work from the World Bank highlighting about the need to have efficient legal regimes that promote effective insolvency. Yeah, and that would be beneficial for the economy. Yeah, and having these creditor or debtor rights that facilitate debt recovery, reduce the cost of credit. So all these can help improve NPL levels. And so, I think also a link should be shown there, just for people to better understand. And also, there was also mention on, of course, the bank performance ratios. Which ones are these that are being used? How are they measured? So what's the link between these ratios and NPLs? So I think just giving that overview. And also the idea of comparisons. If we say that the judicial system in Kenya is slow, what are those comparisons? It was wonderful, maybe how you made a comparison between SVB and Chase Bank. Perhaps the paper could have comparisons maybe on a country levels, perhaps what happens in other jurisdictions, and just to give a good background for the reader. And also, perhaps why there's a need to predict the movement of NPLs. Of course, there would be a need. And also, how does this exponential decay model come in? Just to give that insight. So I would say the discussion was good, at least to give an overview, but some things can be done to improve on it, just to strengthen the paper. I would recommend perhaps for this paper, you could just stay with a discussion of the NPLs and perhaps the effect of the judicial process. These, I think, were your first three objectives. I found that maybe the discussion on the exchange rate could actually form another paper so that you keep this paper perhaps just linked to the idea of NPLs, what maybe the relationship between NPLs and these ratios, the banking ratios, if you want to model the movement of these NPLs or even the judicial process. But even the judicial process on its own, I think that could also be a paper on its own. So I think just to narrow down the focus just a bit, even for your ease, so that you don't have too many things. For the literature review, I think it was a good overview of what influences NPLs, but if it's work that's maybe going to go out there, people may be interested to know what else has been done in the Kenyan context. That's maybe to summarize what I would say. In terms of the NPLs and performance, judicial process, have other studies used these decay models? Why are they beneficial? So just to build up the case for you undertaking this research and using some of these models. For the methodology, I would say to kindly take some time to maybe explain how each of your questions will be answered, just in a simple way that the reader can follow. I think sometimes when we're in a certain industry, we might take for granted the linkage between what we know, but other people may not know. And also highlighting maybe the type of data you're using for the analysis. So I noted that you mentioned you only focused on GDP growth and inflation, but I didn't quite understand maybe why you dropped the other variables. I think there would be important control variables, even though maybe you feel they may not be important, but I think, in my opinion, I think they're necessary when you're doing the analysis, for what's driving the NPLs. And I think also, perhaps for the decay model, again, I didn't quite understand that the values that were used. Maybe there was a value of T in the decay model. There was an equation you showed how you arrived at that value. And also it would be interesting for us to understand what does it mean when you get the decay value of 0.69. What does that tell us as bankers? And perhaps a better idea of how, why the decay model is better. And also, what I found interesting, the judicial process, how exactly does it fit into all this? Yeah, because that's an important aspect. And I think maybe I would mention for the modeling, I think I was wondering whether you really needed to carry out the volatility analysis, to find out that if there is high volatility now, maybe it's likely to lead to higher volatility in the future. So maybe my final comments would just be, when you talk about the ratios and saying that this lending activity drives the asset quality, to kindly explain what exactly you mean, and also the table you showed us just now about as a bank expands, it's like naturally those ratios are becoming worse, so to speak. How exactly did you come to that conclusion is not very clear. And you mentioned about civil cases, the importance of them being resolved quickly, which I believe everyone in the room would agree with. But which findings from your research, again, support this? And also in terms of exchange rate volatility and warranting or perhaps recommending that the central bank could intervene during periods of high volatility, again, to see are there perhaps is this a valid recommendation um, even compared with other jurisdictions? Because, for example, there was a paper from the Bank of International Settlements where they say that there was a review done from central banks, and it suggested that while intervention may work only through the signaling channel, some of the effectiveness may be due to the fact that it was combined with other measures to moderate capital flows or prevent the buildup of certain positions in the forex market. In other instances, it might have helped to exacerbate the volatility in the wrong direction. So I think just to offer more backing, perhaps for the need for central bank to come in during such times. Yeah, so I think that I'll just end there. My last slide was just giving some papers that you could read to also help to enhance this work. But overall, it was an insightful paper and a lot of insights to be gained from reading this. So thank you so much.
Thank you, Dr. Kariuki, for very, very comprehensive comments. I don't know how to start on the comments, but I would want to start with something I think as a long-time practitioner in the industry. There's something we always struggle with. You're familiar with the Pareto rule. I don't know whether we are familiar with it. There's a distribution called Pareto distribution in mathematics. And it says that for any problem you have or any opportunity you have, 20% of the courses will actually give you 80% of the results. And this is something I always struggle with, especially when I'm doing models, because in the field of economics, it seems like always more is better, which is not exactly how it works, I think, among practitioners in any field. In any field, I think we're always trying to look for the fewest causes that can explain most of the problem, so that you just attack one or two things. Yeah, and it's the same thing about, I think you're familiar with Occam's razor, something that came up, I think, from a philosopher. So let me start this way. Maybe before I even go to the final comments, there are quite a number of things I need to talk about. The issue of judiciary, I think, has been mentioned and why it's so important. I think you're familiar with, there's a particular customer actually who got a judgment in 1987 and they're still in court. It was determined even by the Supreme Court, but they're still in court. And this is even after the realization of assets. So that's how bad it has become. There's another one who got a judgment, I think, almost 10 years ago. And it's the one that led to the famous phrase, 3 things. I won't say in Swahili. So that's how it shows actually how important this judicial process is. I think the question on, I think one of the questions I think Dr. Kariuki mentioned, very important one, was to just link again the issue of the NPL to the banking ratios. That's something I think I thought about also. I'll tighten that, and also adding Dr. Tiriongo's comment on the cost-to-income ratio being the industry. I'll tie that loose end, and I think I'll also introduce a bit of the asset quality, non-performing ratio to the asset quality, to the bank ratios. In terms of looking at other regimes. I wanted to do that, comparing, I think I need a glass of water. Yeah, in terms of looking at the regimes, other countries, their legal processes, and the NPL. And this one takes me back to the first issue I talked about, the Pareto rule. Countries that have very efficient legal systems also have very high GDP per capita. And those countries tend to have extremely low NPL ratios. So then how do you isolate the two? I think there's a paper I did earlier, okay, just a draft, that was showing even in terms of something we call economic freedom, which I added here. Economic freedom versus GDP. It's very, I think the R squared was about 70% or heading to 80. So then you just have that challenge of, perhaps then it would be to compare countries that are almost similar to do that bit. In terms of some comments that I think were not, some comments that may require citations, I'll add on that. The other bit is on, I think you mentioned something on exchange rate movements and volatility. I think that one has to be refined, or perhaps we take it to another paper. That could be written maybe as a footnote. On the methodology, that's something I'll work on. Yeah, just to make it very clear exactly how the methodology was arrived at. I think I gave a lot of details about a bit of how the data was obtained, where it came from, how to fill in the gaps, the issues of calculation of VIF. In terms of how I dropped some variables, I think I did a regression for all of them, and then look at the VIFs, and then look at the ones that have the highest impact, and then some of them, like unemployment, I decided to drop because from the ILO website, the International Labour Organization, they cast aspersions on the quality of data for developing countries. So like Kenya, we know the figures they give us are not correct. Yeah. Maybe methodologically it could be correct that people stop looking for work after 1 year, because unemployment reports only people who are looking for jobs, but there are quite a number of people who are probably not reported. The type of data I think I've mentioned. I think you've mentioned some work on from a BIS paper, on the capital flows and all that stuff. The issue of using PCA, I actually considered using principal component analysis, but sometimes when you do that, and because it tends to combine variables in a way that you lose the meaning of the original variables, so it becomes a bit hard to, because it's a dimensionality reduction issue when you're using principal component analysis. And I actually considered that, but I found that I will lose a bit of explaining the model and how it practically can be used. In terms of the decay rate, what it means, the computation, I think I'll combine that with Dr. Tirango's comment in terms of even doing a few scenarios between 4-5 years, 3 to 4, 4 to 5, and then see how it happens. I actually had done in an earlier paper, I think I left it out, and even showing how it affects the overall prediction. The aspect of poor lending practices, it is true. It has been cited also in various papers that poor lending practices can actually affect the asset quality. I think the GFC, the global financial crisis, was able to demonstrate that that happened. The question is, of course, that one, perhaps it has to go with the primary surveys, and I think there are papers that have done using primary surveys, primary research, and data collection. But I think at the global point, it becomes very difficult to model that, especially for the context of Kenya. Perhaps it could make sense, a lot of sense, if a major thing happens. Like, for example, if something happens in the economy and we are not able to, let's say, for example, there's a huge lending currently by the banking sector to the consumer sector. So what happens if the government decides to retrench civil servants? Should we call it poor lending practices? Is it poor lending practices? I think the extreme case of America was, it was extreme. But I of course agree that at the micro level, it is true that even when the global, the overall sector, non-performing asset quality is good, you can have pockets of bad, high NPL ratio, which could be caused by poor lending practice, and it is common, by the way. In fact, even the bank that I mentioned, in terms of one that actually collapsed a few years ago, it was an issue of poor lending practices and inside the lending. But basically, when you look at global level, it becomes a bit hard to point to poor lending practices. In terms of the Land Act litigation, it's true. Land Act has specific timelines for everything, but still the cases are taking so long, much longer than what even the Land Act actually, the milestones as per the Lands Act, largely because of all those issues of taking too, and you know, by the even most buyers shun auction properties because even after purchasing the asset, you can actually end up with another problem that you might not. In fact, I have a friend I know who, I think he even passed away. He bought an asset that was auctioned, and the seller, the owner of the property, the previous owner, refused to vacate. It's that bad. You are paying a loan, you expected to occupy, so people actually shun because of how litigious Kenyans are. I wanted to comment about the CRB data. It could be used, by the way, to estimate even that 3 to 5 years. That's something I can explore, maybe it may not be enough time for that for this year, and see how we can help us to and then of course the comment from Dr. Tiriongo, the implications of this number on the lending policies, and how it can influence future